Chapter 4 presentation, we'll look at accounting adjustments and their purpose in getting our accounts ready to prepare financial statements and communicate financial results. Again, we'll look at this chapter in terms of learning objectives. There are 6 in total. The first one, we will explain why adjustments are needed. The most simple explanation for why adjustments are needed is because we account for our business on the accrual method. Remember, we say that our accounting systems collect information about transactions, and that the accrual method says that we record revenues when they're earned and expenses when they're incurred. Well, accounting systems are often geared towards keeping track of cash and cash transactions, and sometimes cash isn't received in the period when we earn stuff, and it's sometimes not paid in the period where we incur expenses. So we make adjustments at the end of the period to reflect those accrual-based, the accrual-based transactions. So why are adjustments needed? Well, we go back to revenues are recorded when they are earned, not necessarily when the cash is received. Expenses are recorded in the same period as the revenues to which they relate. In other words, we match the expenses to the revenues that they help earn. And one other way to put that is that expenses are recorded when they are incurred. On the balance sheet side, assets are reported at the amounts representing the economic benefits that remain at the end of the period. In other words, if we have an asset that we have partially used up during the period, we have to make an adjustment to that asset to show that we have partially used it up, or in total even. Liabilities are reported at the amounts owed at the end of the period. There again, if the liability has decreased over the period or increased over the period, and that hasn't been reflected through a cash transaction, we have to make an adjustment to that account to reflect the amount that's owed at the end of the period. Let's look at deferral adjustments. An expense or revenue has been deferred if we've postponed reporting it on the income statement until a later period. Remember, in the last chapter we looked at if we paid rent in advance, for example, we recorded a prepaid asset. Now, let's say we use up some of those benefits over the month. We've already paid for them, so no cash has changed hands. And so at September 30, we would need an adjustment to reflect that rent expense from using up the rent that we had prepaid earlier. Similarly, when we had received cash for a service or a product that we hadn't delivered yet, we recorded that as a liability because we had a liability to provide that product or service. In this case, we had received cash for subscription in advance, and we haven't provided whatever it was that these people had subscribed to, either the magazines or the internet service or whatever the case happened to be. And maybe we have then delivered the subscription service over the month, or at least part of this, what we have a liability to deliver. And so as of the end of the period, we would need to make an adjustment to show that we have earned that revenue and reduce the corresponding liability. So deferral adjustments are used to decrease balance sheet accounts and increase corresponding income statement accounts. Now remember, a balance sheet account can be either an asset or a liability, and an income statement account can be either a revenue or an expense. Each deferral adjustment involves one asset and one expense account, or one liability and one revenue account. Now that's a good way to remember these things. So if we're doing a deferral adjustment and we're going to involve an asset account, the corresponding account must be an expense account. If we are doing a deferral adjustment and we are adjusting a liability account, the related income statement account has to be a revenue account. And this bottom box, the blue bottom box, is kind of a summary of how that might work with assets and related expenses, and then liabilities and related revenues. As you can see, let's look at the liabilities. Unearned ticket revenue. That means we have sold tickets, but we haven't actually delivered the event yet. When we actually earn that ticket revenue, we're going to decrease the unearned ticket revenue liability and increase the ticket sales revenue because we've earned it now. So that's one example. Now let's take a look at accrual adjustments. Accrual adjustments, the reason they exist is because, as we've been saying, we record revenue when we earn it and expenses when they're incurred. Well, if the cash hasn't been either received or paid yet, sometimes those transactions won't make their way into our accounting records. And so that's what the accrual adjustments are all about. So let's take the case where we've incurred income taxes this period, but we haven't paid them yet. So at the end of the period, we have to make an adjustment to reflect that income tax expense, even though we haven't paid it yet. So we would do something like debit income tax expense and credit income taxes payable. That would be an income statement account for the expense and a liability account on the balance sheet for the payable. Let's also take a look at maybe we earn interest, but we haven't collected the cash for the interest yet. So during the month, we have this outstanding loan we've made to somebody and where we've earned interest. At the end of the month, we would have to record that interest revenue because we've actually earned it, even though we haven't received the cash. Later on, when we receive the cash, then we would, of course, show that in the records as having received the cash, and we would relieve the receivable at that point. So accrual adjustments are used to record revenue or expenses when they occur prior to receiving or paying the cash. So again, that's part of the accrual basis of accounting. And we also then, along with those, as we record those, we're adjusting the corresponding balance sheet accounts. So again, each accrual adjustment involves one asset and one revenue account, or one liability and one expense account. Now recall how that's a little bit different from the deferral adjustment. In the deferral adjustments, when there was an asset involved, there was an expense associated with it, and when there was a liability involved, there was a revenue associated with it. So it's just the opposite with accrual adjustments. And that blue box at the bottom of the slide again shows us how we pair our balance sheet accounts and our income statement accounts for accrual adjustments. Look at the first one. Interest receivable, which is an asset on the balance sheet, is related to interest revenue on the income statement for accrual adjustments. If we've earned interest, we would debit interest receivable and credit interest revenue if we've earned the interest before we've received the cash. The second learning objective for the chapter is for us to be able to actually prepare the adjustments that are needed at the end of the period. So we actually make adjustments at the end of a period rather than every day. If you think about it, it makes sense. Let's take the case of accruing interest revenue. We probably wouldn't want to accrue, make an entry to accrue interest revenue every day if we're not putting out financial statements every day. What we would want to do is accrue that interest revenue for the period that for when we are actually preparing our financial statements, so that we don't have to do it every day. It's just more efficient to do these adjusting entries at the end of a period to get our accounts ready to prepare financial statements. So take a look at this this top series of boxes on the slide. In the timing column, it says, what do we do on a daily basis in accounting systems? Well, we record transactions every day as they happen through journal entries that are probably part of our accounting system, and they happen oftentimes automatically. And then those transactions are summarized in the ledgers and then in the unadjusted trial balance every day to make sure that our day's activity has been recorded properly. At the end of the month, or the end of the period, we make the adjustments. And to do that, we do adjusting journal entries. And those also then flow through to the ledgers and then what we call the adjusted trial balance, and we use that adjusted trial balance to prepare our financial statements. So again, adjustments are made at month end or at period end as we prepare to make our financial statements. And then to further analyze, okay, this is a busy slide, but I think if you spend some time on this slide, it will really help you understand what's going on in this particular chapter. So let's take a look. We've got an unadjusted trial balance. That is, notice this is at September 30, 2010 at the time. This is a list of all of the accounts in our business, and the balances are in those accounts. They're either debit balances or credit balances, which means when we've summarized or added up the debits and the credits, the net balance in that account is either going to be what we call the debit balance because we've got more debits than credits, or the credit balance because we've got more credits than debits. So I'm going to go down the list even on this slide, and this slide's going to take a while, but it's going to be the review essentially for last chapter and this chapter. So cash is an asset. Therefore, it would normally have a debit balance because you increase assets with the debit. When we use up an asset, we would credit the balance to reduce that amount. So cash has a debit balance, $8,100. Accounts receivable is an asset. Same story applies. Supplies is an asset, normally a debit balance. Now supplies, again, remember we have supplies on hand, and when we use supplies up, we have to adjust that account. We're going to look at the adjustments on the right-hand side of the slide here pretty soon. Prepaid rent we paid in advance would be an asset, therefore no credit or debit balance, Cookware, the equipment we use in our business, both of those are assets. Accumulated depreciation, that is the depreciation that we have recorded, if you will, the allocation of the cost of that, of the related asset over time. And so that is a special account we call a contra asset account. That's, again, where we record the using up of a particular asset over time. And the other account that's associated with accumulated depreciation is depreciation expense, which is an expense account as well. So you have the asset that it's related to, the accumulated depreciation of that asset, and then depreciation expense are all related in some way. So it's good to do it that way. Accounts payable is a liability. Those are amounts that we owe to creditors in the short term for trade items, like when we buy inventory and that type of thing. Unearned revenue is an asset. That's what, if I said accounts payable is an asset, I mean it's a liability. Unearned revenue is a liability. That's money we have collected before we have delivered our good or service, and so we have a liability and an obligation to deliver that good or service or to return the money that we collected. Wages payable is a liability. Oftentimes at the end of the period, our employees have worked, but the actual paycheck hasn't been delivered, or the pay period hasn't ended yet at the end of that period. So what we have to do is we have to record the liability for the wages that have been earned but by our employees but not yet paid, because we owe them that. We have an obligation to pay them that at the end of the period if we were to stop everything and hold up our tab. Income taxes payable is a liability. Interest payable is a liability. Those are amounts that would have been owed but not yet paid. Note payable is a liability. That's a loan we would have taken out from someplace. Generally, notes payable would be non-current, in other words, longer term than just 1 year. And sometimes you could have short-term notes payable as well, but that's a liability in your case. Contributed capital, that's an equity account. Assets equal liability plus stockholders' equity. Contributed capital is a stockholders' equity account. Retained earnings falls under that equity category as well. Both of those have normal credit balances. Dividends declared. Dividends is when we decide, a dividend is when we decide to return some of what we have earned from our business to our owners. And so that is an offset of the capital. It's a reduction of our retained earnings, and so that would normally then have a debit balance. Now we get into our income statement accounts. Pizza revenue is a revenue account. Revenues increase with credit, so pizza revenue or any revenue would normally have a credit balance. And then we get into the expenses. Expenses reduce the equity or the retained earnings of a company. So what we end up doing is we end up netting the expenses and the revenue, and the difference, either net income or net loss, is what increases or decreases retained earnings. And so all of our expenses would have normal debit balances. So you can see each of those expenses: wage expense, rent expense, supplies expense, depreciation expense, utilities expense, advertising, interest, and income tax expense, all would have normal debit balances. Now, the other thing to note about this unadjusted trial balance is that then what we do is we add up the debits and credits and make sure they're equal there at the bottom, and they are. So we know that at least the entries we've made, the debits have equaled the credits. Now we can go ahead and talk about the adjustments that are needed to get us from this unadjusted trial balance to an adjusted trial balance. Once we're to an adjusted trial balance, we can prepare our financial statements. So we look at each of these accounts, and following along with the chapter, the reading in this particular chapter, we can tell what adjustments are needed in each of these accounts. So accounts receivable, apparently in September, we had sold and delivered some pizza, but hadn't collected cash for that pizza yet. So we have to record that sale, and so we would record that with a debit to accounts receivable and a credit to pizza revenue. That would be an adjustment that would need to be made for a transaction that happened in September and didn't involve cash yet. The next one for supplies, we used up some of the supplies that we had bought earlier. We used some of those up in September, and so we have to record that. We would record that with the debit to supplies expense because we've used them up, and a credit to the supplies account, that asset account, because we're reducing the asset because we've used some, and increasing the expense because the expense is the using up of that particular asset. Prepaid rent, again, that's an asset. We paid it before December. We used some up in December. So once again, we're going to debit rent expense to record the using up of that asset, and we're going to credit prepaid rent to reduce that asset. Cookware and equipment and accumulated depreciation. What we're going to do here is, if we have items that we've been depreciating, we're going to have to make that depreciation adjustment to record the allocation of the cost of that asset to the periods in which we're using up that asset. And so we're going to have to compute depreciation and record the depreciation on that asset by debiting depreciation expense and crediting accumulated depreciation for the asset or group of assets that we are depreciating over a period of time. And so that, again, is an adjustment that needs to be made at the end of the period. Then we look at unearned revenue. Remember, that's money, cash we've received, but we haven't yet provided the service. Well, for these gift cards, we actually did meet some of those gift card obligations in September, so we would have to make an adjustment there that liability for those gift cards that actually got used in September, and we would credit revenue for that same amount to record the revenue that we actually earned in September that was previously under wages payable. The amount of wages that our employees earned but hadn't been paid yet at the end of the month would be recorded with a debit to wages payable, debit to wages payable. Never mind, I'm sorry, a debit to wages expense and a credit to wages payable. That credit to wages payable records the liability. The debit to wages expense records the wage expense that we incurred this period but haven't paid yet. Income tax payable. Income tax payable, the same thing. We have incurred tax expense but not yet paid it at the end of September because our income, our net income, revenues minus expenses is taxable. But we don't pay taxes every month, and so we debit income tax expense and credit income tax payable to record the liability and the expense. Interest on our note, because we've had the loan for the month, if we haven't actually paid the interest in cash yet for the month, we have to record that expense with the debit to interest expense and credit to interest payable. That records both the expense and the liability for that interest. Now we slide all the way down to the piece of revenue, and we've already made that adjustment with the corresponding account up in the unearned revenue for those gift cards, and that was the other half of that wage expense. The same thing, we have to record additional wages for the month for those that were earned but unpaid, and we talked about that entry when we talked about wages payable. That was the other half of that. Rent expense, the same thing. If we had rent, we had some prepaid rent up in the assets that we had used up, so we recorded rent expense and reduced the asset for the amount that we would use up in that adjustment. Supplies expense, we talked about that expense when we looked at our supplies asset account up there, where we debited supplies expense and credited supplies asset. Depreciation expense, same thing when we talked about depreciating the assets. And then of course interest expense and income tax expense we talked about as well. So you can see, if you look at these lists, that as we went through the assets and liabilities, it talked about the adjustments, the revenues and expenses were the other side of those adjustments. And so we would make those adjustments we just talked about to adjust our accounts. So after we actually record those accounts and post them, our unadjusted trial balance will now be an adjusted trial balance, and we can use that adjusted trial balance to create our financial statements. So we'll take a look at individual slides very quickly after this, but it was worth spending some minutes on this particular slide. So these next slides, we'll take a look at each of the adjustments we just talked about. So we'll go through them pretty quickly. Remember the first one, we had supplies, and these are the deferral adjustments. Remember where we're going to do an asset and an expense to record the using up of an asset. Supplies used during the period. First, we analyze where it was, and so we say at the beginning of the period, we had 1,600 in supplies in early September, and at the end of September, only 400 remains. The difference of $1,200 was used up, so we have to record the using up of those assets. And so what we would end up doing is, how do you reduce an asset? You credit it. How do you record the related expense? You debit it. And so we end up, look at number 2, where we record it. We debit supplies expense for the $1,200, and we credit supplies, which is an asset account, for $1,200. That records the expense with the debit, and it reduces the asset with the credit. Now, notice in that entry there in number 2 that the debits always go first in your journal entry, and So, and they're always off to the left, indented to the left. The credits then always follow the debits in your journal entry, and they're indented to the right. So that's the proper form for a journal entry. Also in a journal entry, you would generally include the date. So we would have a date to the left of the journal entry of September 30, whatever year it was, and then underneath the journal entry when you record it, you have an explanation for what the entry was. And so our explanation that we would write under that journal entry would be to record the using of supplies in September 9th or 2000, whatever it is. And then finally, number 3, where we summarize this, you can see in our T accounts, our balance in supplies started at $1,600. That was our unadjusted balance at the end of September. And we reduced supplies with that credit of $1,200. So the adjusted balance at the end of September is $400. Supplies expense didn't have a balance because we hadn't recorded any supplies expense yet. We see that we increased supplies expense by $1,200 with that adjusting journal entry. And so our balance, our ending balance, our adjusted balance in supplies expense is $1,200. Now we'll go through the rest of these again pretty quickly. So we had that rent expense that we needed to, we had prepaid the rent and we needed to record using it up. And so we had $7,200 that represented 3 months rent that we had prepaid, but now we have used up one of those, so we have to record an adjustment for the third of that. So we end up debiting rent expense for $2,400 and crediting prepaid rent for $2,400 to reduce the asset. And now we have to record depreciation expense. Now remember, depreciation is just the allocation of the original cost of that asset over the periods in which you're going to be using and using up that asset. So if you recall, we had restaurant equipment for $60,000 that we estimated was going to last 5 years. And so if you take that $60,000 and divide it by 5 years, how many months in 5 years? There are 60 months in 5 years. So that comes out to depreciation of $1,000 a month. So we have to allocate that cost of the asset to the periods in which we're using that asset to generate revenue, and also, of course, using up that asset as we generate revenue. We're wearing it out in this case. And so the account that we use to record the expense is depreciation expense. The contra account that we talked earlier to record the amount of depreciation that we have recognized since the beginning of the life of that asset is called accumulated depreciation. And that credit account, that normal credit balance, is used then to offset the asset when we show it in the balance sheet. It's called accumulated depreciation. So our entry to record the depreciation for the month of September is to record $1,000 of depreciation expense with the debit and to credit accumulated depreciation for $1,000 to show that we have depreciated that $1,000 up to this point. Every month we'll make that same adjustment for the depreciation expense. The depreciation expense is a temporary account that will be closed out at the end of the period. The contra account, the accumulated depreciation, is a permanent account, and we will not close that account out at the end of the period. So let's take a minute to look at depreciation and maybe explain that concept a little better. And we're going to do it using these 3 notes. Okay, in note 1, accumulated depreciation is a balance sheet account, whereas depreciation expense is an income statement account. The normal balance in accumulated depreciation is going to be a credit balance. The normal balance in depreciation expense is going to be a debit balance. What does that normal balance mean? It means how do we increase accumulated depreciation? We increase it with a credit. How do we increase depreciation expense? We increase it with a debit. Okay, so again, accumulated depreciation is a contra asset. It goes on the balance sheet. Depreciation expense is an expense account. It goes on the income statement. Let's look at note 2. what is accumulated depreciation? It's the total amount of depreciation on that asset since the beginning of the asset. So accumulated means it's the total amount that was recorded every period up until this point of depreciation for that asset. So equipment shows up on the balance sheet at its original cost. And then we show accumulated depreciation, the total amount depreciated of that equipment under the original cost. And then we net the two out. And the balance is what we call the net book value, the difference between the original cost and the total amount of depreciation up to this point on that asset. Note 3 is the final explanation of a contra account. A contra account is an account that, this says opposes the account it offsets. In other words, it's an offset to another account. So the accumulated depreciation is an offset to equipment. So the depreciation amount, each period depends on a method. There are several different methods to depreciate assets, and we just use the straight line, which means it's the same amount every period. And we'll get into more of that as the course goes on. Now I'll skip some of the slides for the other adjustments. You can see those slides in the unnarrated slide presentation, or you can follow along with those in the book. Now, a few additional comments that are worth noting. Adjusting journal entries never involve cash. Remember, these adjustments are to our assets and liabilities, and then our expenses and revenues. And so but they never involve cash. Adjusting entries always include a balance sheet account and an income statement account, at least one of each. And finally, a note about dividends. A dividend is a return of retained earnings to our stockholders, to our owners. Dividends are never an expense. It's just a return of what we've earned to our stockholders, and they reduce retained earnings again. So dividends do not appear on the income statement. Dividends are shown as a reduction in the statement of retained earnings. They're shown as a reduction of retained earnings. So again, note, dividends never show up on the income statement. They are not an expense. Okay, now that we've talked through the adjustments, our third learning objective is to prepare an adjusted trial balance, which basically is to take our unadjusted trial balance, add up and subtract all the adjustments, and then the result is an adjusted trial balance. So once we've posted all of our adjustments, we have, and then relist our accounts, like we've shown on the left-hand side here. Remember, starting with assets, then liabilities, then revenues, assets, liabilities, equity, and then revenues, and then expenses. And we have what we call an adjusted trial balance. We have recorded and posted all of our adjustments, and so these adjusted accounts balances now show up in our adjusted trial balance. So notice that in partial listing T accounts on the right-hand side there is what our new adjustments are at the end of the month. Okay, so our cash balance is what it was. Remember, we don't adjust cash. Our pizza revenue account now reflects the adjustments we made, and you can see that the new amount in pizza revenue on this adjusted trial balance is $15,700 when it was $15,500 in the unadjusted trial balance, because we made two adjustments to revenue at the end. Now that we've prepared the adjusted trial balance, we're ready to prepare the financial statements. In order to do that, we have to understand which of these accounts go on which financial statement, and that's learning objective. Now this is a very important sequence of slides, because we are going to discuss which accounts show up on which financial statement and how those financial statements tie together. So the first statement we prepare always is the income statement. Take a look at that income statement in the upper right-hand corner. Three things in the heading are very important: the name of the company, the fact that it's an income statement, and look at that third line. For the month ended September 30, 2010, what we have to do here is we have to tell which period of time for an income statement that income statement covers. Otherwise, the statement is of no use to us. If you create an income statement on the exam, and for that income statement you don't define the period of time that's covered by that income statement, you will lose points for doing that, because it just basically really diminishes the use of an income statement. What goes on the income statement? Revenues and expenses. So first you list your revenues, then you add them together for total revenues, then you list your expenses, you add them together for total expenses, you subtract your expenses from your revenue, the result is net income. In this case, we had net income of $600. The next statement is the statement of retained earnings. Again, three things for that statement: the company, what the statement is, and what period of time is covered by the statement of retained earnings. And it will always be the same period that's covered by the income statement. And what you can show here is retained earnings is the earnings from the beginning of our business, and since this is the first month of our business, we haven't had any. We add to that beginning balance the net income from the period. In this case, it's $600, and we subtract from retained earnings the dividends that we've declared. And we recall that we had declared $500 in dividends, which is a return of retained earnings to our shareholders or our owners. And so the balance is the net income minus whatever subtractions we have, in this case dividends, for a balance of retained earnings of $100. Now, that retained earnings balance is going to show up on our balance sheet. So, our income statement is tied to our retained earnings statement. Our retained earnings statement then ties to the balance sheet. That's how these financial statements tie together. So now let's take a look at the balance sheet. And yes, you will have to use an adjusted trial balance, pick out the accounts that belong on the financial statements. So what accounts are on the balance sheet? Assets, liabilities, and stockholders' equity accounts. On the balance sheet, let's take a look at what we're going to do there. Again, look at the heading of the balance sheet. The name of the company, what the statement is, and for the balance sheet, this is very important, it is for a period of time. This is the balance in our assets, liabilities, and equity accounts as of the end of business on September 30, 2010. So we would say at September 30 or as of September 30, and whatever, for that to indicate the period that we're talking about. So then you have an asset section that you title assets, and we list our assets in terms of whether they are current or non-current assets. Okay, and so current means that we're going to most likely use up or collect those assets within a year within our normal operating cycle. Non-current means they're going to last longer than the year or be used up over a period of time that's greater than just a year. So, and we list them in terms of what we call liquidity. In other words, how close they are to being converted to cash. And of course, cash is our first asset, and followed by accounts receivable, then supplies, prepaid rent, and cookware, because we buy and use up cookware all the time, generally easily within a year, so we just call that a current asset. And so we have total current assets in this case of $13,670. Then we get into our non-current assets, and here's where we show equipment of $60,000. And look at that contra account, accumulated depreciation. All the depreciation we've recorded so far, $1,000. And so as a balance for equipment, we show the original cost less the accumulated depreciation of $59,000. And look at how those are offset on the financial statement. So we show total assets of $72,670. Now, once again, we know that assets equal liabilities plus owner's equity. So the other half of the financials of the balance sheet is going to show liabilities and owner's equity. And those two better add up to $72,670 because our accounting equation always applies where assets equal liabilities plus there's equity. So, again, let's do the liabilities and stockholders' equity section. First, we list the liabilities. Again, current liabilities, those that will be paid off within a year, and then the non-current liabilities, and then we add up our total liabilities, and then we do our stockholders' equity. So, our liabilities section, first again, current liabilities, and we take those from our unadjusted trial balance. We look at accounts payable, unearned revenue, wages payable, income tax payable, and interest payable. All of those are going to have to be paid within a year. So our total current liabilities are $2,570. Now here's an interesting point. Our total current liabilities are going to have to be paid within a year. Our total current assets are going to be converted to cash within a year. So if you compare your current liabilities, the $2,570, to your total current assets, the $13,670, it looks like we're in pretty good shape. It looks like we'll be able to pay our current liabilities with the current assets that we have on hand. So then we move down to notes payable, our non-current liabilities. We have a note payable of $20,000. And so then we add up our current liabilities and our notes payable for total liabilities of $22,570. Then we move to the stockholders' equity section, where we pick out all of our stockholders' equity from our adjusted trial balance. And then we have contributed capital of $50,000, retained earnings. Remember, we did the retained earnings statement on the previous slide, and the ending balance of retained earnings was $100. And then we subtotal our stockholders' equity to $50,100. Now remember, our liabilities and equity have to equal our assets. So the final line on our financial statement is total liabilities and stockholders' equity. We add those two up, and they equal $72,670, which is the same amount of our assets. So at least we know that our statement is balanced. The last narration I'm going to do for these slides is learning objective 5, which is explain the closing process. If you think of business as a game, a sports game, football game, something like that, you can think of the income statement, the income, all those revenue and expense accounts as the score. How well have you played the game for a period of time? Okay, at the end of a game, what do you have to do in order to play the next game? You have to zero out the scoreboard and start over again. Well, if we consider every year a new game for a business, at the end of the year, we have to zero out the scoreboard and start over again. Now, the scoreboard are the revenue and expense accounts, so we have to zero out those revenue and expense accounts. And how do we do that? We take the balances, we transfer them into retained earnings, and we zero out the revenue and expense accounts in that process. So we have a new scoreboard to start the next period, and that's the closing process. So again, we consider revenue and expense accounts temporary accounts that have to be closed out at the end of the year. So let's take a look once more at the timing of our accounting system on the left-hand column here. Every day we record transactions, and some of those are recorded with journal entries that get posted to the ledgers, and then we come up with an unadjusted trial balance. At the end of every month, we make our adjustments, and we do those with what we call adjusting journal entries. And again, those get posted to the ledgers, and then we do another trial balance, a new trial balance that's an adjusted trial balance, and then we create financial statements at the end of the month. Well, at the end of the year, we also, because let's say December at the end of our year, we also would do those adjustments at the end of December, because it's also a month end. But then when we're done with all of that at the end of the year, we do another set of entries that are called closing entries to close out the revenue and expense accounts so that we can start over again the next year. The balance sheet accounts do not get closed out. So our assets, our liabilities, and our equity accounts are considered permanent accounts, and they do not get closed out at the end of the year, because that tells us what we have at any point in time, what we have or what we owe. And so only the temporary also a temporary account, but it is not an expense account. But we want to show how much we declare and pay in dividends every year. And so we call that a temporary account, closing it out to retain earnings as well at the end of the year. Okay, so here's a weird slide. We've got a mirror image of some of these accounts, but in any event, the temporary accounts again are revenues, expenses, and dividends. Temporary accounts track the financial results for a limited period of time, generally the year, because that's our normal operating cycle. And again, think of it as the income statement as the scoreboard that has to be closed out at the end of the game. Okay, now, assets, liabilities, and equity accounts are permanent accounts, and they track financial results from year to year. In other words, they are always there to show you what your balances are, what you've got, what you owe, and what you own at any point in time. So they do not get closed out, because at the end of the period, you've still got all your assets, you still owe all your liabilities, and you still have your owner's equity. So how do you do closing entries? Well, we need 2 closing journal entries at the end of every year. One is to empty out all of our revenue and expenses. And so how do you increase a revenue? You credit it. So how do you decrease a revenue? You debit it. How do you increase an expense? You debit it. So how do you decrease an expense? You credit it. So to close out all of your revenue and expense accounts, and this will turn out to be a long entry, is you debit all of your revenue accounts for the balance that's in each of those accounts, and you credit all of your expense accounts, each one of them, for the balance that's in each of those expense accounts. And when you add up your debits and credits in that entry, there's going to be a difference between debits and credits, and that difference is either your net income, if there are more credits than debits, or more debits than credits, or it's going to be net loss. So in other words, you're going to debit all of your revenue accounts, and you're going to credit all of your expense accounts to bring them to zero, and that difference is either your net income or net loss, and that amount goes to retained earnings. So in other words, if you have to record an additional credit, that's an increase to retained earnings, that would be net income. If you have to record an additional debit to get your debits to balance up with your credits, that would be a net loss if you record that debit to retained earnings, because if you remember, debit reduces retained earnings. So that's the closing entry for revenue and expense. And then we have to close out our dividends declared account. And so remember, dividends declared normally would be a debit balance. And so to close it, we would credit it for the balance that's in there and debit retained earnings, because a debit again to retained earnings reduces retained earnings. And those dividends are a return of retained earnings to our owners, and so we have to reflect that reduction of retained earnings when we declare a dividend. So this is what our closing entry would look like for the Pizza Aroma adjusted trial balance. Notice we debit pizza revenue for the balance in that account, and then we credit all of the expenses to close them up, and then look at the end. We have more debits than credits in this closing entry, so we have to report another credit of $600, which is the net income for the period. We credit that to retained earnings, and that's what increases retained earnings for the net income for the period. Our second entry is where we debit retained earnings for the dividends, and we credit dividends declared to close that account. It normally has a debit balance that has $500 in it. So by crediting that account for $500, it's going to bring it to a zero balance. So then once we post these 2 closing entries and then re-add all of those revenue, expense, and dividend accounts, they're all going to have zero balances, and they'll be ready to begin the next year of recording revenues and expenses and dividends. So now we do one final trial balance, and it's called the post-closing trial balance. And all that does is it makes sure that we have recorded and posted all of our closing entries the right way. And so you can see that our debits still equal our credits, and what's left in our debits and credits now are our assets that have debit balances, our liabilities, contra assets, and equity accounts that have credit balances. Notice that our debits still equal our credits. We've transferred all of our revenue and expense balances into retained earnings and our dividends into retained earnings. And so what's left now for all of our temporary accounts are zero balances. And that's the last step in the accounting process. And I'm going to end the narration here. So go ahead, and if you want to review the effects of adjustments, go ahead and do that, and then make sure that you review solved exercises